Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get you the three catalysts that we're watching this hour.
First up, we break down the market action and why investors' cash holdings are at record lows.
Plus, global stocks getting a boost as the U.S. and Russia engage in talks. We will break down what the discussions could mean for global markets.
And the race for AI dominance heating up as Elon Musk's XAI unveils its latest artificial intelligence model. All that and more coming up right here on Catalysts. New data offering a mixed picture of sentiment on Wall Street. According to the American Association of Individual Investors, bearishness is at its highest level since November of 2023. On the flip side, according to the latest fund manager survey from Bank of America, Wall Street is feeling bullish. The survey showing cash levels among global fund managers to have dropped to the lowest level since 2010 as investors are long U.S. stocks. Joining us now with more, Tom Becker, BlackRock lead portfolio manager, Tactical Opportunities Fund. Great to have you here, Tom. So investors are long stocks, but they're tipping bullish in some other surveys. Where do we net out on how investors are feeling about the market near term?
Yeah, Maddie, good morning. I think the kind of looking ahead from last year, investors are really looking for kind of the fiscal policy, the changes in the new administration to bring U.S. growth up to another level. We see a continuation of the same, so kind of high nominal growth, inflation kind of a little bit outside of the Fed's comfort zone. And to us, the positioning and the narrative that we had at the end of the last year had to shift some of our equity positioning into foreign markets and also position for U.S. interest rates and financial conditions to tighten a little bit.
Where within the foreign markets are you seeing that opportunity, Tom?
Europe was actually a place that was pretty hit negatively by the tariff sentiment. Mm-hmm. So expectations around tariffs really centered around European equities. Europe's had a tough growth run over the last couple of years, but a lot of those companies are pretty foreign exposed. They sell into international markets, and they also have a lot of goods exposure. We're seeing year to date kind of broad-based commodities lift. China may be bottoming, some positive sentiment over the weekend in China. Also some sentiment in Europe now around kind of the rearmament and kind of figuring out how to deal with Ukraine, maybe fiscal loosening a little bit. All of that, given positioning, made Europe a little bit of an attractive entry point.
Would you say that you're more bullish equities outside of the U.S. overall then? Because it's interesting given the run-up that we have seen in U.S. equities. It's been hard to afford to stay out of them the past couple of years.
Yeah, very much so. And so I think we put a lot of weight on what's priced and investor positioning. And I think kind of some of the positioning indicators that we look at toward the end of last year looked a little bit overstretched in the U.S. And so risk return looked like some of these unloved foreign markets offered a little bit better opportunity. If you think about kind of, last year, you had the Fed deliver 100 basis points of cuts. They tapered QT. Coming into this year, it looks a little bit harder for them to be able to deliver another round of easing. Inflation's proving much stickier at 3%. We think quantitative tightening could last longer, given some of the deregulation and some of the loosening of financial markets could allow kind of the balance sheet to shrink more and further than is expected. All of that, we think, could have U.S. financial conditions be a little bit looser compared to foreign markets. That should support foreign equities.
Tom, I'm just curious, just given so much uncertainty surrounding Trump policies and what exactly the impact is going to be, how they are going to evolve here over not only the coming months, but really over the next 4 years. At this juncture, I guess, how big of a headwind do you see it potentially being to U.S. corporate earnings, at least over the next couple of quarters?
Yeah, I think the uncertainty, you kind of point to the right facet of it right here. So it is very uncertain what's going to happen in terms of tariffs, how big, against whom, also kind of the negotiations around one bill versus two bills, TCJA extension, as well as potentially some of the tax cuts that were discussed on the campaign trail. Overall, we think the lean is going to be for more fiscal stimulus. So an extension of the current tax cuts plus additional tax cuts on the margin. That is going to be kind of a little bit of fuel to an economy that's already settling at a high inflation rate, and also is going to necessitate quite a bit more bond issuance when we come into the second half of the year. We think bond investors are going to kind of take heed potentially once we get some of the legislation between the House and the Senate a little clearer about the fiscal ramifications. And I think right here from this juncture in the U.S. economy, additional fiscal stimulus could pose problems for the long end of the yield curve.
It sounds like then the problem is not necessarily the policy itself being implemented, it's more the uncertainty. Given that, would you rather have tariff news that is objectively negative for markets but is clear today versus this back and forth negotiation?
I mean, in terms of how we're positioned, we think U.S. inflation is going to stay sticky and high. So some certainty on the tariffs and kind of the amount of kind of price impact of those would be helpful. That said, I think, our expectation is that there's going to be some constellation of tariffs that is going to keep goods inflation high. Services inflation is already pretty high. And so you add those two together and you get above target inflation. I think the market, in terms of it moving on to a new narrative, as we shift away from the tariffs, I do think it is going to come to some of the things that have to get legislated. And there it's going to be pretty interesting to see kind of which trade-offs and which policies get chosen.
All right, Tom Becker of BlackRock, thanks so much for taking the time to join us here this morning. I appreciate it.
Sure. Thanks very much.
Keep it right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. We'll be right back. The most important time of day for the U.S. stock market may not be between the bells, rather outside trading hours. Big overnight moves could have big consequences for the next day's trade. Let's talk about that and more when we think about your portfolio and hear with what this gap means for your money as Yahoo Finance markets and data editor and also host of Stocks in Translation, Jared Blikre. So Jared,
yes.
Translate all of this for me.
All right, gap. It's only 3 letters. We're going to break it down. It's pretty easy to understand once you see a picture worth 1,000 words. We'll get to that in a second. First, the definition. The gap is when a stock or other trading instrument, could be any security, could be a cryptocurrency, opens higher or lower than its prior close. And even if it doesn't close and there's continuous trading, you can still have gaps. Now, this has important ramifications for not only active traders and day traders, but also passive investors. And we'll get to some of those last. But first, we want to say that gaps tend to get filled. Not always. There's a saying that all gaps get filled. No, there are some Dow gaps from the 19-teens that have not been filled. I hope they never are. And then gap fills often lead to market reversals. And that's on an intraday basis. So let me give you an example of what happened last week in the S&P 500. I'm going to pull up a 5-day chart with daily bars here. You can see four bars here. Yesterday was a holiday, and we haven't had much going on these last 2 days. I want to focus on what happened last Wednesday to Thursday. So last Wednesday, we closed right here, and then we opened up the next morning right here, slightly above that. And it's hard to see, but there's a little wick right here that says that the market went down there, touched this level almost precisely, and then it took off and closed much higher, right around 61.20. So going back to our example here, this has important ramifications also for passive investors because, as it turns out, one of the best times to be in the market is actually while everybody is sleeping. And let me just illustrate that by, we've broken down the market, this entire bull market going back to October of 22, and the different times of day have different results here. So 9:30 a.m. to 11:30 a.m. has resulted in some profits here, but not a lot. You can see it's basically been going sideways for the last 2 years. And then if we take a look at the 11:30 a.m. to 2 p.m., that has trended up and had some nice gains there. And then we take a look at the 2 p.m. to 4 p.m. That is barely positive. In fact, there was a nasty Fed day last month or 2 months ago in December that really brought this back down to zero. But I would highlight that 2 p.m. to 4 p.m. is supposed to be the smart money hour or 2 hours there. Just not the case this bull market. What has been a stalwart is the overnight market. And this has really taken off since about the second quarter of 2021. And you can see this highlighted here. If I break down overnight versus regular trading hours, and the green here is regular trading hours, and the gap is overnight. And you can see this has just really trended up strongly since the beginning or first or second quarter of 2024. after a kind of false start here. We had a lower low in the beginning of this bull market. But as you can see with the green line really hasn't done much over the last year. In fact, you could easily say that it's been trending down. So if you were only in the market during the day, you were missing out on a lot of the gains that are happening in this market overnight. So while not all gaps fill, we do need to pay attention to it because it does have those ramifications for both short-term traders and the longer-term passive investors. Back to you.
All right, Jared, a really great breakdown. Thank you so much. Appreciate it. The latest Bank of America fund manager survey showing investor cash holdings at a 15-year low. Compare that to Warren Buffett, who's sitting on a record cash pile at over $325 billion. While he's put some of that dry powder to use in the fourth quarter, he's also trimmed and exited several positions. Joining us now on this, we've got Lee Munson, President and Chief Investment Officer at Portfolio Wealth Advisors. Lee, great to speak with you. Buffett's cash holdings in particular seem to get a lot of attention because folks are concerned that it is a bearish signal for the market if Buffett is not invested in U.S. stocks. What can you tell us about that?
Well, a lot of this stems from a huge sale of Apple that he did last year, and he just has a bunch of cash and he's slow to get it to use. They have been on a buying spree with Occidental, and I think that that's something that is notable. They bought a ton in December. They bought a ton this year. And so I think it's about what qualities that Buffett likes, and he's looking for things that have strong cash flow, assets that aren't going to go anywhere. And I think he's got a real, he's got a real love for Occidental because they have these quality properties, or let's just say these assets in the Permian Basin, and they're paying down debt. So I think that what it really says is that this is a momentum market. It's hard to find good value right now. And I think that Buffett is waiting his time. But I don't think we should, have this, I don't think we should think just because he has a lot of cash, it means the market is ready to fall per se. I mean, look at Occidental. In the past, since I think last April, it's down 30%. And so there are things in the market that are down, beaten up, left for dead that you can buy here.
Lee, what do you think this tells us about Buffett's and his team's just longer term strategy, just in terms of the opportunity that they have identified within Occidental? They like buying beaten down stocks. They like seeing some of the companies that they could potentially turn around. So what does this signal maybe about that strategy and what that looks like for what's ahead?
Well, I think there's some sense that, there's always going to be Buffett haters. There's always going to be people who think that what that team does is too slow moving, that there's not a lot of, there's not enough opportunity set. I disagree. I think it's just a style. We're in a market for years now that has been based on big tech companies promising ever larger growth and in revenues. But I think that when you look at the type of trades that he's doing and the type of positions that they're putting on, it really goes, I don't think anything's changed in 10, 15, 20 years or even beyond that of what their strategy is. I think that you can look at what they're buying and it's just a completely different philosophy of the market than is Facebook going to hit their earnings and are they going to have an AI agent by the end of the year.
To focus specifically on Occidental, though, it's interesting because, and you mentioned this in your note, it's not a company that is hedged on oil prices and, of course, is at risk of the potential depression in oil prices, which is something that we have been seeing. How risky does that make this name, particularly given both the geopolitical backdrop abroad and then also here at home?
Risk, I think Buffett said risk is not knowing what you're doing, and I think that the Occidental is a good example of this. I was long this stock several years back when it was in the high 50s, early 60s. It went sideways for a while. I wasn't making money, and I had to go and get busy. Now you come back, you look around, you think, hey, this thing's down 30% from where I last traded it. We're going to see some earnings today. We're going to see how bad the cash flow is. I think that you have to take a longer term view. Do you think that assets in the Permian Basin are going to be more or less valuable 3-5 years from now? Do you think that upstream, the exploration with Trump's America right now, do you think that's going to be a headwind for Occidental? I think so. Occidental, the narrative is confusing. They've got midstream, they got the chemical company, they got the carbon capture, and I think Wall Street doesn't like not having a pure play. But I think that if you like assets, if you want to do an asset play, and you believe that Buffett really believes so much in Occidental and their management team, I think it's worth looking at. But I would rather wait for some bad earnings. I'd rather wait for Wall Street to completely leave this thing for dead. It could get worse because their cash flow is going down right at a time that they need to be paying down debt. So I'd actually like to take a page from Buffett's thing and rejoice when stock prices are down. I just think Occidental has a lot of risk this year. We've got a president who's trying to lower energy prices, but on the other side, he's going to loosen up regulation. And the strategy that Occidental is doing right now, it's great. Just remember, you're not going to get a clean narrative. It's never going to be a hot momentum stock. And if it's going to work, it's going to be a sleeper hit.
Lee, what about some of the other moves that we've seen Berkshire make? Constellation Brands, that's a new holding here, adding to Domino's, adding to Pool Corp, adding to SiriusXM. What does that tell you?
Well, I think he's just knee-deep in the value trade. I mean, he just does not care about some of the broader things that are happening in AI or what have you. They're looking at staples. They're looking at things that people use every day. I'm fascinated by the satellite radio. I'm on satellite radio every day. It's not something that's going to go away. I've got, a ton of cars. I'm always upset, someday I'm going to call them and say, stop charging for my teenage daughter's car for $10 a month. But you know what? He knows about inertia. He knows about the U.S. consumer. And so I think that you can look at that, and I think he thinks that the U.S. consumer is just fine. They're going to keep paying for staples, and a moat is a moat. I just think a lot of what he's doing is unpopular right now. And until we see some big disappointments in the Mag 7, you're not going to see a lot of lift on these stocks.
All right, Lee, always great to talk to you. Thanks so much for taking the time to join us here this morning.
Thank you.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of this session. That's what the Yahoo Finance's trending tickers page. First up, merger talks between Honda and Nissan could potentially be back on, with one caveat though. Nissan's current CEO must step down. That's according to the latest report from the Financial Times. Now the FT is saying that the $60 billion merger will become the fourth largest automaker in the world. Of course, this has been a back and forth. Previous talks had pretty much collapsed because of some of that internal resistance inside Nissan. So of course, this is contingent upon the fact that only if Nissan CEO agrees to step down here, Maddie. But I think this more so highlights just the tough position that Nissan is in right now, just in terms of the fact that they're dealing with tougher competition, especially what's happening with domestic players inside China. They talk about the fact that obviously that has weighed on earnings most recently. They've been forced to lay out some cost-cutting measures. So the future of Nissan, as they stand on the company, obviously very much in question, I would say challenged, at least at this point, in terms of the view from the street.
And it's interesting, too, given that we are seeing the move in Nissan to the upside and Honda to the downside. You never want to see that when you are the CEO and your stock moves to the upside on rumors of your potential ousting. Makoto Yoshida is the CEO of Nissan. He has signaled an interest in staying in the role at least until 2026. So given this scrutiny from the board, it may not be enough to obviously make him have a forced exit. But this merger with Honda, really critical for Nissan, which has been struggling with sales in Japan and more broadly across the globe due to some of that competition from electric vehicles in Asia that we have been seeing continuing to pressure Nissan. So they are certainly looking for a potential deal. Having said that, we also know that Foxconn has been considering that stake in Nissan following this deal falling through with Honda. So that's another potential partner for them moving forward if this deal does not go through or revive in talks, which has been on again, off again relationship over the past couple of years.
Something tells me this is not the last that we're going to be hearing about this.
Exactly, absolutely. All right, well, Alibaba shares also moving higher. Investors looking ahead to earnings out Thursday before the market open. The Chinese tech giant coming off a strong week amid AI optimism and its partnership with Apple. Alibaba co-founder Jack Ma was among those Chinese tech leaders who met with Chinese President Xi Jinping on Monday as the country is looking to become more business friendly. It's hard to overstate how critical that meeting was, too, because Xi Jinping has not been meeting with business leaders for several years now. Jack Ma has not been seen in any of those meetings for several years. So really critical to see kind of that friendlier approach. And I think it's interesting, given that it sort of mirrors what we've seen here at home with the White House favoring big tech CEOs, having that friendlier relationship, and now we're starting to see that abroad as well. That led to a lift in Chinese tech names overnight. It'll be interesting to see if that can sustain into those Alibaba earnings.
Yeah, that certainly is a great point. And you take a look at Alibaba, just the stock performance over the last year very much speaks to the outlook and the impact of the potential there surrounding AI growth and some of the investments that have been made. When you take a look at that 1 year chart, you are looking at gains of just over 7 70%. So again, going into the results later on this week, expectations are high. But again, when you talk about the focus, even within China, of some of their more domestic players, you talk about the fact that they are very competitive, remain very competitive to other worldwide leaders. You certainly have seen some of the concern here within the U.S. when we got the developments out of DeepSeek and potentially what that means. And then, of course, the news from Alibaba following just a few days later. So again, when you take into account just where China stands right now, the competitiveness that they are offering on the AI landscape and where they are within that race and the competition that they are providing here to the U.S., certainly a lot will be riding on that specific portion of the results that we are going to be getting at. We'll see whether or not it does live up to those lofty expectations.
Yeah, and the interest in investing in tech abroad is something that we're going to continue to monitor. We're talking with Mitchell Green later in the show, venture capitalist, and he'll be giving us his insights on the AI trade as well. We'll have all your markets action ahead, so stick around for those conversations and more. You're watching Catalysts.
Elon Musk's artificial intelligence startup debuted its latest chatbot to challenge OpenAI days after the billionaire's bid to buy the company was rejected. Now, XAI claiming that its Grok 3 chatbot beats DeepSeek, OpenAI, Alphabet, and Anthropic's models across several benchmarks. Joining us now to discuss the race in AI, we want to bring in Mitchell Green. He's the founder of VC firm Lead Edge Capital. Mitchell, it's great to have you back here on Yahoo Finance. Let's first talk about some of these developments that we've gotten here over the last several hours from Elon Musk, some of the capabilities, what he's claiming just in terms of how advanced Grok 3 is. What do you think that means just in terms of the implications and immediate implications here for the broader AI industry?
Well, Madison, thanks so much for having me on. What do I think? I think you're going to see over the next 6, 12, 18, 24 months, lots of people continue to, show that their models are faster and faster. As you saw in DeepSeek, you'll see that things get, cheaper and cheaper. I think it's going to be a long race. And at the end of the day, I think the largest companies in the world will probably end up winning this race. It's just incredible how much money companies like Microsoft and Google and Facebook and Amazon are going to spend on this stuff over the next few years. I think it's, something like $250 to $300 billion or something in the next 12 months for some of these large internet companies. I don't know how some of these private companies can keep up, but we shall see.
So it sounds like you see that CapEx as a negative, Mitchell. I want to get your take then on some of these kind of old school names, the likes of Oracle, IBM, Cisco, really outperforming some of those other Magnificent Seven names that you just mentioned. Do you see that dynamic continuing? And do you see those kind of old school names becoming AI winners?
That's a great question. Companies, Oracle is already, I think Larry has come out and said that he wants to aggressively invest in AI. I'm sure IBM will as well. IBM's for years has had things around machine learning. The companies that are, the companies that are supplying equipment, technology, all of these, these hyperscalers that are trying to spend these giant CapEx dollars are going to win, are going to at least win in the near term by providing giant amounts of capital into this sector, equipment into the sector. I worry a little bit that this is the telecom boom and bust, although it did eventually boom again. I just worry that we will provide so much, there's going to be so much infrastructure needed, and we'll overbuild for it in the near term. But over the long term, I guess another way to put it is people tend to overestimate technological change in near term, but they always tend to underestimate it in the long term. And then, of course, spending, kind of goes the same way.
Mitchell, I guess what metrics then are you using to evaluate just where this race stands with AI and some of the larger companies, obviously much larger companies, versus some of these startups?
Yeah, so in the startup world, we have what's called our Lead Edge 8 criteria, and it's how we evaluate every business. One of the key criteria that we like to evaluate is what we call gross dollar retention. That is, if you end the year December 31st with $10 million of revenue, at the end of the year, 12 months later, at the end of the next year, what are your revenues from those exact same customers before you have any upsells. So a lot of entrepreneurs like to quote they have 130, 140, 150% net dollar retention, which includes the upsells, which would be downsells plus upsells. However, best-in-class software companies tend to start with $10 million on Gen 1 and end the year with, $9 million. So they'd have 10% churn, 90% gross dollar retention. World-class companies have 95%. Oftentimes, we're looking at many of these pure AI startups or earlier stage companies, and we're seeing them have gross dollar retention of $5 million or 50%. The problem is they're just churning through customers so fast. And what you're seeing is a lot of companies trying things. Some things kind of work out. Some things kind of don't work out that well. And so for us, the pure AI software companies, as a result of low gross dollar retentions, has been our biggest impediment to invest in the sector. That being said, every portfolio company in our portfolio is playing around with AI, just as I'm sure you guys are at Yahoo or CNBC and Bloomberg, and everybody is. Everybody's trying things. Some things work slightly better than others. It's still the very early innings, but we have every company in our portfolio has tasked different people in the organization to figure out how to use AI in different ways.
So is AI for efficiency's sake enough, for cost cutting enough, or do you want to see these companies charging for AI? Do you want to see ChatGPT paywalled?
I think you're going to see it because the costs of providing the service are much more expensive than your typical search. You're going to see Microsoft come out with products. There's already multiple tiers that you can pay for, OpenAI. I think there's the $20 a month and there's the $200 a month one for deep research on it. Look, we have companies in our portfolio that are not only working on cost-cutting initiatives, but trying to also drive revenues through the use of AI technologies embedded in their own products. Where we see a lot of companies winning is the incumbents. And I think it should be stressed that when the iPhone came out, what was it, 2007, 2008-ish timeframe, there's only been a couple companies created since that came out that are worth over $100 billion. You have ByteDance, you have Pinduoduo, they're roughly around there, and Uber and Airbnb. You know who won with the iPad and the iPhone? It is Apple, Amazon, Google, Facebook. I think you're going to see the same thing here. You're going to see companies such as Genesis in the call center space. You're going to see companies like Grafana Labs, which is a really fast-growing developers tools company. You'll see companies like Salesforce and Workday. They're all going to embed AI inside their systems and leverage their existing customers to continue to grow faster and faster.
So then, Mitchell, I guess the investor question here is, what does that next wave of AI investment, who are there winners beyond who's already leading?
I suspect so AI will change the world. It's going to change it over the next 10, 15, 20 plus years. If you looked at the internet boom in 99 or 2000, I don't think we would have sat on this show and said the winner, the definitive winner today is going to be Amazon, and the other giant winner will be this company you've never heard of called Facebook, and this company you've never heard of called ByteDance. And, but by the way, Walmart is also going to build a giant e-commerce business. And so I suspect companies that will be the biggest companies in AI over the next 20 years will be companies that we haven't even thought of, that like are in their infancy now or not even created. But yet companies such as Salesforce, Microsoft, Workday will build giant businesses. OpenAI, they've built a huge consumer brand. It's obviously really powerful, and it's taken the hearts and minds of consumers right now. But I just don't know how that company can compete over the long term with the amount of money that these large hyperscalers are spending on CapEx. Not that it's an incredible product. I use the product, but I struggle with, can the foundational models come out of a company other than one of the big hyperscalers, just given the CapEx requirements? But time will tell.
Mitchell, I want to end on ByteDance. Obviously, you are an investor. TikTok's fate in the United States still up in the air a little bit. It's back on the app stores, though. How do you suss out the viability of your investment in ByteDance, given just the lack of transparency into the company? What is it that you're seeing that other investors might not be seeing?
That's a great question. Well, to be clear, there are other big investors, General Atlantic, Sequoia. You have people like I think Hill House is an investor in it. Cotu. You have a bunch of Tiger Global. You have a bunch of very strong other investors. For us, our base case has always been, since we made the investment over the last few years, is that the U.S. business, we valued it in our model at zero. The U.S. just isn't that much of the overall business right now. We get financials on the company. We're happy with the financials. We have access to senior executives at the company we can talk to. Well, we are not on the board of the company, nor we were not on the board of the company of Alibaba as well, or we were not on the board of Uber or Spotify, but we were provided financials and management access, and which is fairly common in a large investment in some of these large giant private companies. For us, I would say that for several years we've said the value of the U.S. business was zero. It sure appears, looking in, that the U.S. government and Trump want to do something to keep the app in the U.S. for U.S. consumers. I think that probably benefits us as American investors in the company. Whether it's a it'll be some type of spin out. Your guess is frankly as good as mine on what that would look like at the end of the day. But I think as a U.S. investor, we will probably actually accrue some value to it that we had really created no value in our model with.
Yeah. All right, Mitchell Green, thanks so much. Appreciate it.
Thanks for having me.
We're going to have all your markets action ahead, so stick around for more on Yahoo Finance. You're watching Catalysts.
U.S. and Russian officials at meeting in Saudi Arabia today for extensive negotiation talks as President Trump pushes to end the war in Ukraine. Notably, no Ukrainian officials were part of those discussions. The State Department saying that the meeting is a second step to see if Russia is serious and on the same page. What would an end to the war mean for investor sentiment and the energy trade? Should we see a lifting of sanctions on Russia? Joining us now, we want to bring in Andrei Kozyrov. He's a former foreign minister of Russia, and also Patrick Dahan. He's the head of petroleum analysis at Gas Buddy. It's great to have both of you. Thanks so much for taking the time. Andrei, let me just start with you, just in terms of what is your assessment of the talks that are taking place as we speak right now today? The fact that Ukraine is not involved, the fact that Europe is not involved, what does that tell you?
Well, unfortunately, I think neither Ukraine nor European Union miss anything. This looks like very, very empty. They call it preliminary or exploratory, but that's just diplomatic, speak. The talks with Russia, with Putin's Russia, without force, demonstrated force, and even used force, lead nowhere. And the talks in Riyadh ended, as far as I understand, by comments by both sides. There are more comments actually in Russian press, but official also, that there was no movement. Russia stands on its maximalist demands and made no step even aside from that. And they created 4 or something working groups. But working groups on what? On what happens after the peace agreement. And maybe one to look how to reach the agreement or ceasefire, whatever. But that's just, a kind of blame game. The primes, the presidents might blame ministers for not reaching the agreement, and ministers in their turn create working groups to blame them. But from the very beginning, it was absolutely clear to me that Russia will not compromise anything. And they're supposed to compromise their demands for gifts or rewards from the aggression. That is how much more land they will keep, how much more restrictions like demilitarization they will dictate on Ukraine or no NATO. Some of those things already accepted by American side even before the negotiations. But anyway, only force. That's the language that Putin speaks at home, using force against his opposition and everything. And that makes their demands for elections in Ukraine so disgusting, so ironic that there have been no elections, free and fair elections in Russia for 25 years, at least. Yeah. So his concern with the legitimacy of Zelensky is just ridiculous. But that's what they do, they understand force and nothing more.
So, Patrick, I want to bring you into the conversation because it's important to note what Andrei is saying here was echoed by Vladimir Zelensky, who said no deal about us without us. Obviously, Ukraine not involved in those discussions. Given the lack of clarity about the likelihood of this resolution coming to fruition, how big an impact do you anticipate happening in terms of the energy market and crude oil specifically?
Well, look, I think there could be huge implications for the U.S., for Russia, if a deal does materialize. But to your point, it's not going to be as successful if Ukraine doesn't have an active voice at the table. If Europe's interests are forgotten, now the U.S. is assured that as these talks potentially progress, there will be room for Ukraine and potentially interest from Europe. And I think the Trump administration certainly could carve out somewhat of a victory here if everything goes well, if sanctions on Russia are eased. That certainly could put downward pressure on oil. And of course, President Trump has promised to lower energy prices. So there are huge implications. But the biggest question is, will Russia move forward? Will they add demands? And how successful will the talks be?
Andrei, how likely is a meeting between Putin and Trump?
I can add something to the oil as a Russian foreign minister. I try to follow the oil kind of drama or play, and it's absolutely impossible to predict the curve of the oil price even for short time, not to speak for long time. And if Russia is now trading oil with China and India on discounts, but still, and if sanctions removed, they will trade more. But that does not necessarily mean a lowering of the oil price, because it's a very, very tricky subject. And also what is important, that even if Saudi Arabia and Russia and all other OPEC or whatever concede to lower the oil price, then the oil industry in the United States might be hurt much more than Russian oil industry, which is established, and especially Saudi oil, which is cheap and high quality. So you should be careful what you ask for.
And Andrei, to that point, we are seeing some support in the markets here, at least today, for the crude market when you take into account the strike that we saw potentially at that pumping station in Russia. But going back to what I asked before, just how likely do you think is the meeting that we are going to see within the next several days, within the next week or two, between Putin and Trump?
You can have as many meetings as you wish, but that's humiliating for the great power America is. I live in America, and I'm an American taxpayer, and I feel very badly for my country, new country, to be humiliated because Putin uses that. He scores politically back home and in the eyes of China and other countries of the world, that he talks equally like an equal, being a war criminal. He is war criminal. When President Trump says that part of Ukraine had been obliterated, it's exactly right. But who did it? Who started all that? Putin. Putin can call the war back, just telling his troops to go back home to Russia. So what's the point of those empty talks? For Putin, it's political gain. For America, it's humiliation.
Andre, we got to leave it there. Thank you so much for joining us. Andre Kozyrev and also Patrick DeHaan with Gas Buddy. Appreciate it.
Thank you.
Coming up, we'll dive into the latest bullish call on gold, why one analyst sees the safe haven topping $3,000 this year. That's next on Catalysts. There's a new bullish call on Wall Street, with Goldman Sachs raising its year-end gold target to $3,100 an ounce. Yahoo Finance senior markets reporter Inez Ferre has the story. Hey, Inez.
Hey, Maddie. Yeah, and Goldman's prior target was $2,890 by the end of this year. The forecast now is, as you mentioned, $3,100, as demand from central banks is structurally higher. Central bank demand, led by China, will add 9% to the gold price by year end. And we saw last year all-time high levels for gold demand led by central banks. Well, Goldman analysts are also basing their predictions on an uptick in ETF buying. However, they do go on to say that if policy uncertainty, including tariff fears, stays high, then you could see speculative buying, sending the price of gold to $3,300 per troy ounce. And right now we're seeing gold prices at just above $2,944 per ounce. Goldman's base scenario, by the way, assumes that the Fed will cut rates 2 times this year. If the Fed funds rate stays flat, though, gold may come just shy of their price target. Year to date, you're seeing that gold futures are up more than 10%, guys.
We have seen that rapid move to the upside. All right, Inez, great stuff. Thanks so much.
Thank you.
Keep it right here. Wealth is coming up next, dedicated to all of your personal finance needs. Brad Smith has you for the next hour.